Hello there everyone, today's video is all about the capital gains tax treatment of selling overseas assets. So let's dive straight in. Fundamental rule number one, translate everything into sterling. So the sales price of your overseas asset and the cost price of your overseas asset, you need to translate those into the sterling amounts at the relevant times. That's the fundamental rule number one. So let's look at an example and work through this. Now, let's suppose you bought a villa in Miami. Be nice, wouldn't it? $500,000. So, 500,000 US dollars. And then let's say you sold this villa in Miami several years later for $450,000. So actually, made a bit of a loss on that. You've made $50,000 loss. However, forget dollar loss. What we're concerned about, because we are assuming that you are a UK resident, is your UK tax position on this property transaction. What does it mean from a capital gains tax point of view? Because just because you've made a US dollar loss, we don't care about the dollar loss, we care about the UK position, which is as follows. So, like I said, rule number one, translate everything into sterling. Purchase 500,000. Let's assume the exchange rate was 1.3 US dollars to the pound. So the sterling cost of that overseas property in Miami, 385 grand based on that exchange rate. But then assume the exchange rate has moved in the years between purchase and when you sold it, and the exchange rate when you sold it was 1.1 US dollar to £1 sterling, which is about 409,000. So you made a $50,000 loss, but you've actually made a gain as far as UK equivalent is concerned, 25 grand. Cost you 385, sold it for 409, just shy of 25 grand. So what does that mean? Well, that means, as far as the UK taxman is concerned, that you've got a capital gain. Forget the fact that you've got a $50,000 US loss. Now, commercially, you'll probably be thinking in dollar terms. I think, my God, why have I got a loss here? I've made a loss on this property. Why have I got to pay the UK taxman? But them's the rules. Translated in sterling works out as a UK capital gain. Now, gets even worse in this example. Let's assume this particular chap borrowed to acquire the property. Property cost him $500,000, and he took out a US mortgage of, let's say, $300,000. And what he did was, let's say, it was an interest only, so the capital didn't move all the years that he had the property. And when he sold it for $450,000, he repaid $300,000 mortgage out of the proceeds. What about that? Well, again, let's translate that, see what that means in UK sterling terms. So 300 grand, when he took the mortgage out, 300 grand dollars, same exchange rate, gives us 230,000 pounds. So that's the loan in UK equivalent. But when it came to repay it, the exchange rate had moved, and it cost him £272,000 sterling terms to repay it. So he took out this loan, 230 grand sterling equivalent, but had to repay the equivalent of 272 grand sterling. So in effect, this is a loss on a loan on the mortgage, £42,000. He had to pay an extra £42,000 when he repaid this mortgage. So what does he do with that? Surely, because like I said at the top of the video, we care about the UK position. So you've got a UK gain. So then you might think, oh, great, he's got a UK loss now on the debt. Can we do something with that? No, is the answer to that. You can't. Next point. Capital gains tax is only concerned with assets, not liabilities. Therefore, the UK CGT regime doesn't give two hoots about mortgages. De nada, nothing. So this loss that he's made on the mortgage, the fact he's had to fork out an extra 40 grand to pay it off in sterling terms, UK taxman doesn't care. So you can't do anything about offsetting this loss on the mortgage against the gain on the asset. Forget it. Oh, okay. So CGT on assets, not liabilities. Right, so okay, so we'll still come back to this UK gain. Now then, what else can we need to think about? Well, of course, the UK is not the only jurisdiction that might have dibs on a property transaction. Now, it could be, in this example, I've engineered it so that you've basically got a loss, in the US and a gain in the UK. But let's say, for example, these numbers were different and this guy had doubled his money on a property play in 10 years and he's got a dollar gain and a UK gain, however which way you cut it, he's got a gain in both jurisdictions. Now, what the double tax treaties say, normally, they say that the country where the property resides has first dibs on the gain of wanting to take tax off the person who owns the property in their country. So in this case, it would be the US. So fundamentally, you look at the tax treaty and the US says, okay, we know you're not a US citizen or resident and you live abroad, but your property's here. We want first dibs on the tax, and you pay the US taxman tax on the gain. But then because you're a UK resident, the UK taxman also wants tax on that. And thankfully, the double tax treaties say, look, there's this thing called double tax relief. And basically, you'd look at your UK bill and you'd knock off US tax that you'd paid against your UK bill, the sterling equivalent of the US tax. So whatever the amount that you'd suffered in the States reduces your UK tax. That's all fine and dandy, but in this case, we haven't got gains in both jurisdictions. We've got a loss and a gain. So you cannot offset US losses against UK gains. That's fundamentally the issue here. What you'd like to do is somehow say, oh well, okay, we've got a UK gain of 25 grand and a US loss of 50,000 sterling. Is there some way that, based on the double tax treaties, the double tax treaty says, well, UK is reduced by whatever happens in the States? Yes, it is, only when it's positive, when there's actual tax to reduce. If you're in a loss situation in the States, it doesn't work. You cannot say we're going to set off the US loss against our UK gain for capital gains tax purposes. It doesn't work that way. Can only offset US tax paid against the UK gain. If there are US losses, you cannot set those off against UK gain. So just an overview really on the capital gains tax implications of buying and selling overseas assets. And I would suggest that most people who are in this boat, the asset would be a property. But it's, like I said, fundamentally, it's many people would think, hang on a minute, surely if we've got a loss, economically, the whole thing was in dollars, we borrowed in dollars, we sold and bought in dollars. Doesn't matter. If you're a UK resident, everything's got to be converted, and it all hinges on the movement in this exchange rate, because that's where you can come a cropper, where all of a sudden your foreign denominated loss becomes a UK denominated gain. So just bear that in mind. Secondly, I think a lot of people as well assume there's some sort of relief on mortgages. Mortgages have got nothing to do with capital gains tax. This includes, by the way, just solely a UK play. Forget overseas. You've got a UK property, you've got a UK mortgage, you're selling it, capital gains tax you need to work out. Forget the mortgage. The mortgage has got nothing to do with it. I think a lot of people think that it does, but it doesn't. So no CGT implications on mortgages. So if you like this video, please do subscribe, and as always, I'll see you soon.